So welcome to our videos on financial analysis through the use of ratios. This is the second video in a series of 5. I'm Stuart and I will walk you through these. And in this video, we're going to be looking at the operating efficiency ratios. And these will see how effectively a company uses its working capital. Now, before we start, if you haven't seen these videos before, or indeed if you're not sure on the structure of financial statements, then please do have a look at the link here. There's a short introduction to financial statements, which at least give you an idea of the structure of those statements, and that will help you understand how these ratios all come to play. So as we look at these operating efficiency ratios, we're trying to concentrate on how quickly does an organization turn its working capital, or how efficiently does it use its working capital. And we're going to look at some of the different components of the working capital. We'll be looking at the accounts receivable, the inventory, accounts payable. But what we're going to do with these ratios is we're going to convert them all into days, which then allows an easier comparison and an easier benchmarking for those. So we'll have a look at accounts receivable days to see how many days outstanding they've got with accounts receivable, how many inventory days they've got, so inventory days outstanding. We'll have accounts payable days, so how many days have we got outstanding with our accounts payable. And then we'll bring all of those together to understand the working capital cycle. So how many days have an organization got of working capital available? And then the last ratio that we'll have a look at is slightly different, which will be the asset turnover ratio. So let's start off with the calculation of our accounts receivable days. So what we're taking here is we're going to take the accounts receivable from the balance sheet, and we're going to divide that by the net revenue for the year. And then we're going to multiply that by 365 days to give us a ratio that's stated in days, which really, the reason for doing that is just make it easier to compare against prior periods or as industry standards or competitors. Now, if we have a look at this for Smart Retail in 2026, they had accounts receivable of $120.9 thousand. Now, if we divide that by their net revenue, so $5,995,995, and then multiply that by 365 days, that gives us a number of 7.36. Now, what that means is we've got about 7.36 days outstanding. Now, is that good? Well, again, what we have to look at is what are our credit terms. If I'm an electrical retailer, then a lot of my products, people are going to be paying as they walk out the store. So really, on one hand, this could be zero. But I will also have some industrial customers, so some business to business customers, and they may have some credit terms. So as I balance that, if they've got 30-day terms and they make up a, whatever proportion of my business, if it was half, then I'd be expecting about 15 days here. If it's a quarter, about 7.5. And that's what I've got to be really comparing it to. Where do I expect it to be from my business? Now, the other way to compare that, of course, is to compare it back to where was it last year? Is it fairly static? Is it stable? How is it compared to some of our industry competitors as well? But here, if I look back at 2025, like I say, I go through that same calculation and I had 7.67 days. So it's very similar in the same sort of ballpark. I've had a marginal improvement this year, reducing down to 7.36. Now, if I have a look at my inventory days to understand how much inventory am I carrying. Now, with inventory, this can be a challenge because we don't want to not have inventory in store because then we won't be able to make a sale. But if we've got too much inventory, then it becomes obsolete and I lose money on that inventory. Plus, all the inventory that I've then got to have somewhere to store it. So trying to get that right balance of inventory is really important. But here, how do I calculate my days inventory outstanding or my inventory days? Well, I'll take my inventory balance from the balance sheet. and I will divide that by my cost of goods sold. So all of the sales that I'm making through the year. And once again, I'll multiply that by 365 to turn it into a day's inventory outstanding. Now, if we have a look at this for Smart Retail, we have $994,000 divided by my cost of goods sold of $4,657,000. Multiply that by 365 days, gives us 77.9 days outstanding. So that's a reasonably large amount of inventory that will be there. But again, we've got to understand that in the context of our business, where an electrical goods retailer will have a lot of inventory in store and we want to try to turn that. And so therefore, 77.9 probably doesn't feel too bad. But a good way to compare it, again, let's go back to the previous year and see, are we comparable? Is it consistent? And so if we have a look at 2025, we can see that days inventory outstanding was 75.43. So what that does tell us is that we've got slightly a greater amount of inventory, certainly from a dollar value, than what we had in previous years. Now, is that a problem? Well, this is where it leads us to maybe we'd want to have a bit more of analysis. On the face of it, it doesn't look too concerning, but if it's the start of a trend and we've got the wrong type of inventory, then it might be something we need to understand a little bit further. So now the third component of our working capital, and in one way how we can finance our working capital, is to have a look at the accounts payable days. So what this is meaning is how much are we relying on our suppliers to give us credit to manage our inventory and accounts receivable. Now, on one hand, the greater that is, the better it is for the organization. But similarly, we need to be fair with suppliers and we need to have a good relationship with them. So it's really important that we negotiate the terms and then we pay to those terms. But if we have a look here at how is it calculated, well, we're taking our accounts payable divided by our cost of goods sold and multiplying by 365 days. Now, we'll mention here in some organizations, they may go a little bit deeper with that and look at your accounts payable divided by your purchases rather than total cost of goods sold. But when you're looking at that more externally, it can be harder to get that internal information. So we can often take accounts payable divided by cost of goods sold. Again, to give an example of this, let's have a look at it for Smart Retail. And we can see for Smart Retail 2026, their accounts payable was $620,000 and their cost of goods sold, that $4,657,000. So if we multiply that by our 365 days, we get an accounts payable days or days payable outstanding of 48.59 days. So what that's meaning is we're getting on average 48.5 days of credit from our suppliers. Now again, is that good? Well, this is where we've really got to compare it to what are our typical trade terms. If our trade terms were 60 days, then maybe we're paying a little bit early. If they're 30 days on average, we're paying a little bit late. The chances are we've probably got a bit of a mix between the two of those. And that's where, again, let's compare it back to where we were last year and assuming there haven't been any material changes. Last year, now if we have a look, the ratio was 47.67. So we can see it's holding pretty steady. We're marginally longer this year, but not quite a day, just a little bit less than a day is the change. So it looks like it's pretty consistent. Now, the final part of this, we can bring those three ratios together. We can have a look at our accounts payable days, the inventory days, and the payable days to understand our cash conversion cycle. And we can show this as a bit of a waterfall diagram. So we can see, well, how many days are we financing our working capital by accounts receivable? We add on our inventory days, and then we will subtract our accounts payable days. And the net balance is how much working capital are we financing, or our cash conversion cycle? How long does it take us to turn our working capital into cash? So if we have a look at this for Smart Retail, we can see that the accounts receivable days were 7, We have 78 in terms of our inventory days, less the 49 days of credit that we're getting from our suppliers, our accounts payable, which gives us a cash conversion cycle of 36 days. So ultimately what that means is we've got just over a month that it's taken us to convert our working capital into cash. Now, again, how does this compare? Well, what we can do with this, if we have a look at, as an example of the electrical goods retail industry, and this is a bit of an approximation, but we can see a similar sort of cycle. There's a little bit less in terms of the inventory days, and the payable days are greater. So what this means is that traditionally within the industry, then other organizations are getting more credit from their suppliers. And that's what's happening in that. When we look at that as an example, is that actually the suppliers are financing the organization's working capital because the cash conversion cycle is a negative number. Now, just to give a different take, if we then have a look at, for example, the manufacturing industry, and again, be careful of these when you look at industry comparisons. You've got to be careful which countries are you looking at and which companies are involved. But broadly, we can see that our accounts receivable days in the manufacturing industry are somewhat longer, some of those 59 days. Again, this could replicate those business to business customers, and therefore, rather than being 30 days credit or people paying as when they take the goods, they're actually getting close to 60 days credit. We've got inventory days as we aim to build up our inventory to convert them into our finished goods of 85 days. And then we're trying to get some of that credit from our suppliers, and on average be 75 days. So the cash conversion cycle here would be just over 2 months at 69 days. So what that gives is it's an example of how understanding our industry and how do we compare is really important when we look at these ratios. But we've also got to understand what is happening within the organization. So the final ratio we're going to look at in this domain is the asset turnover ratio. And this is a little bit different because the other ratios we've been looking at are testing our working capital. This is now going to say how efficiently do we use our total assets of the organization. And what we're looking at is we're going to look at our revenue that we generate, so our net revenue, divided by our total assets for the business. Now, for smart retail, if we take our total revenue of 5,995,000 and then divide that by our total assets, which is $2,924,000, then we get a ratio of 2.05. So what that means is we turn our assets about twice a year. Now, if we then compare that to the previous year, we see a ratio of 2.23. So obviously we're seeing a slight worsening within our asset turnover ratio, which what we need to do is we need to have a look and say, well, why is that happening? Is that a concern? Is there anything problematic that might be causing that? Or is it something that is within our tolerance and where things are going to be sitting for the organization? And similarly, as we've said before, we could also be comparing these across the industry norms as well. So when we look at the summary of the operating efficiency ratios for smart retail, we can see there's nothing majorly to worry about here, but there might be some areas where we could ask some questions. Our working capital ratios are all fairly close to where they were last year. That results in the cash conversion cycle also being fairly close, just that modest increase of 1 day. But it may lead to a question around our payables outstanding. Are we missing an opportunity when we compare it to the industry? The industry generally have around 70 days payables outstanding, whereas we're in that high 40 days or 48, 49. Now, there could be good reasons for that, but it's always worth looking at that analysis. What is in the industry analysis? Is there any reason why it should be different, or is there an opportunity that we can take up? And we come to the asset turnover ratio. We can see we've had about a 10% reduction in asset turnover. Now, about 50% of that reduction can be explained because we increased our cash balance, which again, when we look at liquidity ratios, and we'll see that in the the series looking at liquidity ratios, that's not a bad thing, holding a little bit more cash, as long as it's aligned with strategically what we're trying to achieve. However, we've also had a bit of an increase in inventory and an increase in our plant and equipment. Again, not necessarily problematic. We might need to keep an eye on the inventory, but maybe the biggest factor is that our sales didn't really increase this year compared to last year. So therefore, whilst our balance sheet has grown, the revenue didn't, which has actually caused that reduction in the asset turnover. So what we need to do as an organization is just revisit our focal point. Is it that we do have a sales problem here, or do we need to start aligning the size of our balance sheet and our working capital and assets in broadly this case to make sure that they fit the size of our business? So that is a wrap in terms of our operating efficiency ratios. Please have a look at the other videos in this series where we look at liquidity ratios, we've looked at the operating performance, and we'll also be looking at some of the financial structure ratios as well. If you're interested in learning more about financial statement analysis, have a look at the online course which is included in the comments below. It will take you through some of the steps we've covered off here, the introduction to the financial statement analysis, and through that we'll give you also a summary of Smart Retail's financial statements so that you can work through those numbers and go through the calculations. It will also go through each of the steps, the operating performance, profitability, and bring through a real world example. So we'll have a look at the real company and see how this translates in the real world. And it will also be supported by short activities at the end of each section so that you can test your knowledge and make sure you've got a good thorough understanding. Now, each of these steps and that we'll work through on the course will be supported by short little videos like what you've seen in this particular video. And at the end, it will also come down to a summary section to summarize what does it all mean, how do we use it, and what other information do we need to consider.